All right, let's talk about building a portfolio. But forget all that day trading hype, all the noise you see online. Today, we're going to build something that's actually designed to work for you, something that gives you real freedom and, lets you sleep at night. We're moving past the philosophy and getting right into the action plan. Let's do this.
I love this quote because it just cuts through all the nonsense. It is so easy to get distracted, right? Chasing the next hot stock, the next big thing. But the real goal, the one that's going to matter 10, 20, 30 years from now, is to build something that's dependable, something you can count on when things get shaky.
And this is the big question, isn't it? It's the one that seems to trip everybody up. You might own a few good companies, maybe an ETF or two, but how do you pull it all together into a system? A real system that's actually moving you toward the life you want to live. That's exactly what we're going to break down.
So what are we actually trying to build here? Well, first off, it's got to be durable. It has to be able to take a punch from the market and keep on standing. It needs to be aligned with you personally, where you are in life. Every single thing in it has to be purposeful, there for a reason, not just on a whim. And this one's huge. It has to be peaceful. It shouldn't be a source of stress. And finally, it's got to be flexible because guess what? Life changes, and your portfolio has to be able to change right along with you.
Okay, first things first. This is maybe the most important building block, learning to pay the right price. And here's a little secret that a lot of people miss. A fantastic company can be a truly terrible investment if you pay too much for it. The price you pay is every bit as important as the quality of what you're buying.
Here's the best way to think about it. The price is like the daily weather forecast. It's all over the place. It changes every second. It's totally unpredictable. But the value? The value is the climate. It changes really, really slowly based on the actual health of the business. Our job is to completely ignore the daily weather and focus on buying the great business when the price is lower than its long-term value. That little gap between the two, that's everything. That's your margin of safety.
And look, you don't need some fancy finance degree to figure this stuff out. Here are 3 super practical tools. First, you've got the PE ratio. All this tells you is how many dollars you're paying for $1 of the company's profit. It's a fantastic quick reality check. Then there's P/FCF, or price to free cash flow. This one is my favorite because it compares the price to the actual cash the business generates. It's perfect for checking if a dividend is safe. And last, EV/EBITDA. This one's a little more advanced, but it's the best way to compare companies in the same industry because it includes debt in the picture. These are like your 3 essential tools for the job.
And this classic quote from Buffett just nails it. Your first job is to find a wonderful, high-quality business. But your second job, which is just as important, is to demand a fair, sensible price for it. When you get that combination of quality and price, that's where the magic happens. All right, so we know how to find a good company at a fair price. But how do we actually put them all together in a portfolio? Well, it really comes down to this simple but really powerful idea of balancing income and growth. And for that, we're going to use a blueprint I call trees and saplings.
First up, we have our trees. And you can picture these, right? They're the big, sturdy, old-growth companies in your portfolio. They provide the stability, the shade, the income. We're talking about those mature, dividend-paying giants. They're not necessarily growing like weeds anymore, but they produce dependable cash flow that you can use to live on without having to sell off your assets.
And then you've got your saplings. These are your growth engines. They're the younger, faster-growing companies. They might not be paying you a big dividend right now because they're pouring every spare dollar back into the business to get bigger and stronger. The whole point of these is that one day they're going to grow up to become the giant, income-producing trees of your future.
So what does this actually look like? Take a look at this. Now, this is just an example for someone maybe moving toward financial independence, but you can see the balance in action. About half of it is in those stable, income-producing trees and similar assets. That's for today. But a huge chunk is also in saplings, which are the growth engines for tomorrow. And you always have that bit of cash as a safety net and to jump on new opportunities. It's all about that blend. Stability for now, growth for later.
Okay, so you've done the hard work. You've bought the right companies, you paid the right price, you've built a balanced portfolio. You're all set, right? Well, not so fast. Now comes the hardest part, and honestly the most important one, managing your own behavior. We have to build a calm, disciplined process for taking care of what we've built.
And the key to all of this is learning to separate the signal from the noise. The signal, the stuff that actually matters, is your portfolio's income-generating capacity. Is the cash it's producing going up over time? You monitor the fundamental health of the businesses you own. The noise, that's the daily stock price wiggles, the talking heads on TV trying to scare you, the hype on social media. You have to learn to ignore all of that. You're a business owner now, not a stock watcher.
And look, this doesn't have to be some stressful all-day event. Just set a simple rhythm, maybe once a quarter, and run through a simple checklist like this one.
Is my income going up? Is my tree and sapling mix where I want it to be? Has anything fundamentally changed with one of my companies? And where am I going to put my new savings? That's it. This keeps you in control and stops you from making emotional mistakes.
All right, our last big piece of the puzzle is this really powerful but super simple idea for managing risk. It's all about building some guardrails for yourself so that no single investment can ever blow up your entire plan. We call it the 20 slots framework.
It all boils down to just one number, 20. Now, this isn't some magic formula, but it is an incredibly powerful way to think about your portfolio. Just imagine your entire financial world is divided into exactly 20 slots. That's it. This one little constraint changes everything.
Here's how it works. It's so simple. Each of those 20 slots stands for 5% of your money. This automatically builds in a safety rule. If one of your investments does really well and grows to, say, 10% of your portfolio, well, it's now taking up 2 of your slots. That forces you to stop and ask, am I really okay with this one position having twice the power of everything else? It's a circuit breaker.
Now, this is where it gets smart. It's not a one-size-fits-all thing. You can adjust your slot size based on the risk. A big, stable, blue-chip tree, yeah, that might earn a full 5% slot. But a faster-growing, more volatile sapling, maybe you cap that at 3%. And a really speculative idea, you might only give that a 2% slot. It forces you to be intentional about how much risk you take with each decision. Okay, let's pull the camera back for a second. We've talked tactics, we've talked about valuation, trees, saplings, and risk. But what are we really building here? All of this is designed to connect back to one thing, building a system that actually supports the life you want to live.
Because when you put all these pieces together, you're not just looking at a list of stocks, you're building a system that literally pays you to exist. You're building a financial engine that creates more get-to-do moments in your life instead of have-to-do moments. And ultimately, what you're really building is an anchor for a life built around sufficiency and peace of mind.
So I want to leave you with this question. Because at the end of the day, the portfolio, it's just the tool. The real work is figuring out how to use that tool to build a life that actually means something to you. The money isn't the goal. The freedom is. The time is. The peace of mind is. So the real question you have to ask yourself is, what kind of life are you building?